Let's start a new topic, everyone, for today, which is a part of cost of equity. Another model that can be used to find out the cost of equity, which is model. Bracket may I'll pull it down as with tax. So the formula is very simple over here, which states cost of equity is equal to cost of equity of ungeared company 1 minus tax multiplied by cost of equity of ungeared company minus cost of debt divided by value of debt upon value of equity. Okay, so this is one model that can be used. Now, where will you be using this model specifically, everyone? In the APV questions. For the very first part where you have to go and solve for the base case NPV, over that part you will be using this model, everyone, to find out base case NPV. Now, while calculating base case NPV, you will remember we need a cost of capital which does not include any debt. So now when I talk about this KEI, what is this? This KEI is actually cost of equity for an ungeared company. Okay, this is actually cost of equity for an ungeared company. So you will be actually trying to find out KEI only. Okay, you will be only using KEI. Majorly, you'll be using calculating KEI only one. So this formula majorly this formula is used for APV ब्रैकेट में base case. Okay, this is what and how this formula will be used, everyone. Okay, there won't be a lot of questions that will be tested over here. This is the very first thing that you need to remember. Now, there is one more model that can be used to calculate the cost of equity, that is your CAPM model. We have already solved and discussed this topic number of times. Okay, we have discussed this topic like number of times, everyone. Now, what does it mean, everyone? It actually states two things. There are like betas and number of things that we need to discuss before we actually discuss on to this topic. Now, when I talked about dividends, over there what we discussed ki we can calculate the cost of equity using the dividends. That was the very first part. Then second we talked about MM model where we discussed ki the cost of cap equity can be find out using the ungeared, matlab the value, the debt that we have, and based on that we can find out the formula. This is the second model that we talked about. Now when I talk about CAPM, okay, so CAPM pe I'll just put down the formula, but this topic will be discussed in depth in the later part of the class, that I'll assure you, everyone. Okay, so we have a complete topic on that. So CAPM won't be discussed directly. So let us cover this part as well on how this risk part is actually covered. Okay, so whenever we go and invest in a company, there is always some risk which is involved. Okay, there is always some risk which is involved. We all know that. Okay, now this risk is actually called as beta. This risk is called as beta. Okay, investors will try to maximize returns for the risk, and there is some risk which is always unavoidable. Okay, there is some risk which is always unavoidable, and the returns that the investors want for that unavoidable risk is called as mean variance efficiency. Okay, and this concept mean variance efficiency is used to find out the CAPM. Now, when I talk about CAPM, I'll actually bold it a little more. CAPM is actually called as . capital asset pricing model. This is one of those topics that can be tested in the numerical part as well. Yeah, that is the interesting part, that this is also tested in the numerical some of the times. So what are the questions that can be tested? So very first thing that we need to understand is called as risk, actually, everyone. Now within risk, there are again many things. So I'll use a greener pen. First of all, risk. Risk is of two types, denoted by beta. Now risk can be first unsystematic and systematic. These are the two types of risk. Unsystematic risk is that risk which can be diversified away. These risks are because of the risk uncorrelated. For example, let's say you have invested in only textile sector and there is certain bad news about the textile sector, so your portfolio will fall. But if you have invested in all the sectors which are possible, then because of just change in one variable, not your complete portfolio will not fall. So now if I talk about unsystematic risk, which it can be diversified away. The risk that can be diversified away. Systematic risk, it cannot be diversified away. Unsystematic risk can be diversified. Or systematic risk cannot be diversified. Cannot be diversified. For example, COVID-19. No matter in how many areas you invest, will you be able to go for that? Will you be able to avoid that risk? No, that is not possible. Unsystematic risk, let's say there is a fall in oil prices and you are selling oil. So what will happen? You are an international seller. There has been a fall in the prices. The revenue will fall. But if you have been selling oil, if you have been running airplanes, if you have been working in the paint sector, so decrease in oil is one risk. But because of that, your other industries will also flourish. Correct. Your other industries will also flourish. That becomes your unsystematic risk. Always remember, unsystematic risk cannot be diversified. Systematic risk can be diversified. In a very nutshell language, everyone. Always denoted by beta 1. Now, this beta 1 can be, this beta can be 1, beta can be more than 1, and beta can be less than 1. Now, what does all of these means? If beta is equal to 1, yani the risk in market and risk in your portfolio is same. We'll call it neutral. When market risk and your risk is same, it is neutral. When beta is more than 1, it's risky. I'll call it riskier than market. If beta is more than 1, then your investment is riskier than market. When beta is less than 1, safer than market. These things have been tested in theoretical parts, everyone, okay? And sometimes beta can be given as 0, which means risk-free. It is risk-free. Okay, so these are the different meaning of betas that we need to understand, everyone. There is one concept which is given in your study hub about the security market line, everyone. So basically, security market line shows the relationship between the systematic risk and the required return, which states that if there is any share or any investment which is above security line, which is above security line, then it is fine. But if it is any share or investment which is below security market line, it should be sold. Okay, it means we are not getting the enough returns onto that. Generally not tested, but just for the user case, I'm telling you. Now, the formula of this topic, everyone, that is the most important point. It goes cost of equity, which is equal to risk-free rate plus beta risk at market minus risk-free rate. This is the formula. Okay. I'll denote the meanings over here. Risk-free rate. Beta you already know. Then over here, market. We already know all these meanings. Correct? So the questions over here are actually very simple. You don't have to worry about anything. Sometimes exam may they directly give you RM minus RF as market risk premium. What they call it, everyone? Market risk premium. So don't get confused if they give you market risk premium. Okay. Now there are certain assumptions over here. Certain assumptions over here which are very important. Okay. Assumption number one, that markets are efficient. Markets are efficient. Now, what do we mean by efficient markets, everyone? That investors are rational. There is no transaction cost and information is available to everyone at zero cost. The corporate and the personal taxes are almost the same. Correct. This is the very first thing which states that markets are efficient. Then second point, again, very important. Second point, that investors can borrow and lend at the risk-free rate. Investors can borrow and lend at risk-free rate. What does it mean, everyone? That whatever the risk-free rate that you have provided, investors can go and do a lot of transaction on that rate only. On that rate only. Third point, market is, remember the word mean variance efficient. Mean variance efficient. What does it mean? That the investors are risk averse and seek that their investment should provide maximum return for the risk that they are taking. Investor market is mean variance efficient. Correct? And portfolios are diversified. Possible to have a diversity it is possible to have a diversified portfolio. This is the most important assumptions that we have, everyone. Now, for the point that investors are, the information is freely available. I'll pull down one photo over here for you only. This is the meaning of efficient market appeal. Okay. These are the important assumptions that we need to follow. If in exams they ask you the limitations, but you can use the assumptions to present as a risk-free rate. Sorry, as a limitation as well. But still there are certain limitations that we have. For example, The variables which are used by the company, for example, beta, risk-free rate, market risk, all of these are not that easy to find. Hence, it is a problem, right? And it is considered that everyone has a diversified portfolio, but in real, it is not true. Correct, it is not true. It is almost impossible to have a diversified portfolio for everyone. So it is not true. So there are two problems. One is lack of data. I'll note it down as limitations. Lack of data, lack of accurate data. Okay. Then second, impossible to have diversified portfolio. Impossible to have diversified portfolio. These two are the important limitations that we need to remember. Okay, let's move forward to the second part of the CAPM, where we will use the CAPM to APV question. Now, beta, while reading down the CAPM question, did you notice the beta that is being used? This beta. So now let's understand beta. Okay. So there are two types of beta, everyone. First, we have beta equity and then we have beta asset. So we are going to use beta equity, which includes both financial risk and business risk. Financial and business risk. Now, when I use financial risk, actually, I am talking about debt being introduced. Now, if I talk about beta asset, I'm just talking purely about business risk and no financial risk. That is the one point, beta equity and beta asset. Now, guys, while solving these questions, we are always using beta equity. To calculate cost of equity, we use beta equity. Why? Because we all know that the value of equity, the value or the cost of equity gets influenced by the cost of debt as well. So it is very important that we talk about this part. Now, when I use beta equity, I get cost of equity over which debt has been considered. Can I use beta asset to calculate cost of equity? Yes, you can. And this is what we have been doing, everyone. I hope that you all remember this formula where we use beta asset. We calculate beta asset actually using formula as value of equity upon value of equity plus value of debt 1 minus tax multiplied by beta equity. This is the formula that we have been using, everyone. Correct. This is the formula that we have been using. Against it, we again have another formula which talks about that and we multiply beta of debt. But since this company is considered as ungeared, right? And asset beta is therefore ungeared. That is why beta debt becomes zero. So overall, whatever over here is becomes zero. So it does not matter. It does not matter that we write it down or not. So we'll simply write this much as the formula. So use this beta asset to find CAPM. Okay, we use this beta asset to find CAPM, everyone. That is actually used to calculate my cost. Okay, that is actually used to calculate my cost. So this is how we use the beta in the APV question as well. I'll show you one example, everyone. Uses electronic component but is considering venturing into a computer manufacturing. Now you might have a question ki, why is this happening actually? Why are we using different betas? But if we are moving from one business to another business, so what will change? Business risk, right? So that is why we need to find out beta asset. That is why we need to find out beta asset use that beta asset. Remember, we will be using that beta asset, put down into my financial component and then calculate my cost of capital. This is one type of question that can be tested. Definitely we'll solve some questions over there. Okay. Is an ungeared with an equity beta of 0.8. Ungeared with an equity beta of 0.8, everyone. The average equity beta of a computer manufacturer is 1.4 and the average gearing ratio is 1:2. The debt beta is assumed to be 0, which is unsaid thing. The market risk-free rate and the following information is given. Now we have to calculate the discount rate that we should be using to appraise computer manufacturing project. Computer manufacturing. So don't you think that first of all we need to find out what is the business risk of computer manufacturer? First of all, we need to find out business risk of computer manufacturer, everyone. So we find out beta asset, which goes for value of equity, which is 1 upon bracket में 1 plus another bracket 4 into what is the tax rate? 33. So over here 0.67 multiplied by what is the beta? Beta is given as 1.4. Solve this part, everyone. We'll get how much? 1.2 f 1.2. Now this beta asset can be used to find out my value of my cost of equity. Now you might say, sir, why are we directly putting this formula in cost of equity? Because other things are already given. Risk-free rate, market return, and company tax. Things are given. So my cost of equity, if I enter into this business, what will be that? Yeah, you might have one question. Sir, why this is beta asset? Okay, you told me this concept is actually called as ungearing and gearing. Okay, you just told me first of all I need to find out ungeared question, ungeared uh, equity, ungeared beta. Then I have to re-gear it. But you are not doing re-gearing. Why? Because beta, this question pay we have equity beta, which is a company's ungeared. So matlab there is no debt. That is why we are not doing. Generally, the normal steps would be, I will write it down, ungearing and then re-gearing. Okay, this is the normal method. Over here, we are not doing that. I'll write it down separately. So over here, what needs to be done? If you look, everyone, 5 into, what is the question? 1.2, 1.2, market return 12 minus 5. That will give you my cost of capital, which is equal to 12 minus 5, 7, 7, 12, 9, 9, 13.4. That is the normal way. So now what actually happened? If I had to pull down all the steps that we have taken, first of all, we ungeared or de-gear. I'll call it as de-gear the proxy. The de-gear the proxy beta. De-gear the proxy beta. That will give me beta asset. I'll remove this point. Might confuse you guys. Okay, de-gear the proxy beta. Then step number 2. Step number 2 में guys, you will re-gear using above beta asset. Now regearing using above beta asset onto your financial risk, onto company's financial risk. Okay, I'll put down company's financial risk, which will give me beta equity. Okay, which will give me beta equity, everyone. So these are going to be the two steps. Okay, let's read it once. We use the equity beta, right? Absolutely, we use the equity beta because why are we using asset beta? Beta in APV questions, the very first step will include the base case NPV. In those base case NPV, we want a discounting factor which does not include any cost, which does not include any cost of debt. That is why when I'm using asset beta, no cost of debt has been considered. That is why we are using asset beta to calculate my cost of equity. Now solve this question, everyone, using the method that we just talked about. So if I look at this question, it is actually very simple. It looks very large at first, but when we actually start solving, it is pretty simple. Let me read the question first. Mercury company provides training for companies in the computer and telecommunication sectors. It offers a variety of courses ranging from short intensive courses in office software to high level risk management courses. Okay, Mercury employs a number of, okay, no, not important. In recent year, Mercury has diversified into the financial service sector and now also provides computer simulation systems to companies for valuing acquisitions. Now accounts for 1/3 of the company's total revenue. But whenever these things are given 1/3, 1/4, 1/5, you won't be able to use business equity. Always have to use business asset because this is business risk, not the financial risk. Jupiter company is one of the few competitors in the Mercury company's line of business. However, Jupiter company is the only involved in the training business. Jupiter company is listed in on a small company investment market and has an estimated beta of 1.5. Okay. Jupiter company has 50 million shares in issue with a market price of 5.8. The average equity beta for the financial sector is given and the average debt beta can be assumed to be 0, which is a good point for us. Averaging market gearing in the financial sector is estimated to be 25%. Financial sector, this is financial sector. Okay, above one was the communication and now we have financial. Both the data is given. Beta, what is the requirement in the company? Estimate the cost of capital, cost of equity capital, and the weighted average cost of capital for Mercury company. This is the requirement. Now, what do we need to solve for? Always look for that. We need to solve for cost of equity and cost of debt. Correct. We need to solve for cost of equity and cost of debt. To calculate cost of equity, always look what do you have? Do you have anything? So you might say, sir, I do have equity risk premium, risk-free rate because it says government short dated debt fund is 4.5. Both companies can raise debt at 2.5%. So KD is directly given as 2.5. Now, what else do we have? Company ka tax rate is given. Do we have the cost of equity? Sir, we can use, what can we use? Sir, we can use CAPM. Beta CAPM pe we need beta asset. What do we need? We need beta asset. Sorry, we need beta equity, but to calculate beta equity over here will be a tough task for us. So let's start with the first part, everyone, which is to calculate the beta equity. Now you might say, sir, how to calculate beta equity? Is there any method? We can do one method, sir. We can just put down, remember that degearing and regearing. So over here बेटा we have one company. ठीक है, यहाँ पे notice over here we have one company which is involved in training business. Estimated beta is this much, market price is this much, and then we have one company जिसका data is given over here. Correct everyone? So now we have to use this data only to calculate our beta asset. Correct. We have to use combined beta asset. Sir, why combined? Because beta, our major business is computer and telecommunication, and 1/3 of my business is financial wala. Okay. So the very first step that I need to take will be to calculate beta asset. For that, I will need value of equity and value of debt. What is value of equity of my company? Is it given? Is it given, everyone? 1 point estimated, not my company, the other company. 50 million shares, 50 multiplied by 5.8. What will be the value, everyone? $290. Okay. This is for the company where average is given as 1.5. And the average equity beta for the financial sector is given as 0.9. Okay, now what is the value of debt which is given? Up over here, notice one thing. 290 is my value of equity, right? Up over here, how are we actually going to solve this question? It is very important, right? The key is to build up Mercury's asset beta as the weighted average asset beta of training sector and financial sector. Two sectors, training sector and financial sector, right? Now, financial sector will be 1/3 of the total revenue. Training will be 2/3. Correct? Are you getting my point? That is the major point that we have to remember, everyone. Now, while solving this question, we are Mercury and we have one more company which is called as Jupiter. This is the data which is being provided. And market, the financial service sector is estimated as 25% directly provided us, so we don't have to worry much over here. I think that we don't need to calculate the value of equity and value of debt. Why? Directly given at the end, 30 and 12. So first of all, let's go for beta asset. What will be the value of equity, everyone? Directly given, gearing is 12. Then debt proportion is 12. So what will be the value of equity? 88 divided by 88 plus 12 multiplied by what is the tax? 40% directly. Left, I am left with 60%, 0.6 directly. Multiplied by Jupiter. Jupiter ka what is the beta? 1.5 multiplied by 1.5. Let's solve this part. And what is my asset, beta asset? $1.39 every. This is my beta asset of which sector? Mercury is in which sector, everyone? Which sector is Mercury in? ट्रेनिंग बिजनेस. ठीक है, ट्रेनिंग, दिस इज ऑफ ट्रेनिंग, फर्स्ट सेक्टर. नाउ आई वांट बीटा एसेट ऑफ अदर सेक्टर विच इज योर फाइनेंशियल सेक्टर. फाइनेंशियल सेक्टर का डायरेक्टली गिवन है 25%. ठीक है, एंड एवरेज इक्विटी बीटा ऑफ इज 0.9. तो हाउ मच विल बी दैट? 75 divided by 75 plus 25 into 0.6 multiplied by 0.9. Whatever is here, everyone, what is the final amount? 5 0.75, and this is for the financial, correct? Now we have the betas. We have the two betas ready. Now average beta, average asset beta. We all know, we all talked about it, that this 1.39 is equal to 2/3 plus this 0.75 is equal to 1/3, everyone. It is given. I told you we cannot do this 1/3 and 2/3 with equity beta. Otherwise, there was no requirement to calculate beta assets. We could have directly taken that. This can only be done in beta asset because beta asset talks about business risk. Beta equity talks about financial risk, everyone. Please remember that part. So what is the total? Let's find that out. 125. 0.18 will be your asset beta. Now this abhi tak beta, whatever the process we have done, this process is called as de-gearing. What is this process called? De-gearing, everyone. Now we will move to the next process that is called as re-gearing. What is the next process? Re-gearing. Asset beta is given, correct? So I'll write down as 1.18, correct? Simple. Now look at my company. Look at my company. What is my company name? Mercury. Mercury ka data is given 30%. Mercury's data says 30%. So 30% data equity will be 70 upon 70 plus 30 into 0.6 multiplied by beta equity. Now, beta, this is we have beta equity, that is what we are trying to calculate. Okay, this is beta equity that we are trying to calculate. Okay. Now we just solve this part. That will give me 30 into 0.6 will be 15, I guess. 70 plus 1.18 will be equal to 70 upon 70 plus 18, 88 multiplied by beta equity. So 1.18 multiplied by 88 upon 70 will equal to beta equity. 1.18 multiplied by 88 divided by 70 equal to 1.48. So beta equity will be equal to 1.48, everyone. This is your beta equity. Now, this is beta equity only. Still, I am supposed to calculate cost of equity. That will be equal to, what is risk-free rate? Risk premium is 3.5, risk-free rate is 4.5. 4.5 plus 1.48 into 3.5 because risk premium is directly given to me. So that will be equal to 3.5 multiplied by 1.48, which gives me 5.18 plus 4.5, which gives me 9.68%. This is my cost of equity. My cost of debt is directly given, everyone, so I don't have to worry about it. Both companies can raise debt at 2.5% above the risk-free rate. So 4.5 plus 2.5. 7% is the cost of debt. As simple as that. So can I go and calculate my WACC now? WACC, everyone. What is my cost of equity? 9.68 multiplied by proportion of equity. Sir, 70% directly given. 70% plus value of cost of debt is how much? Cost of debt is 7%. Make it post tax. 7% multiplied by 0.6 equal to 4.2. 4.2 multiplied by 30%, which will give me the final value as 6 multiplied by 0.8, 7.744 plus 4.2 multiplied by 0.3, 1.26. So my final answer would be 9%. Just to check everything is right or not. 9.6. This is 6 point. So my final answer would be 8%, everyone.